Jon Callaghan joins us today from the Bay Area. He is managing partner at True Ventures, a leading early-stage VC firm that he co-founded in 2005. Over the past 20 years, True has partnered with more than 1,200 founders across 500 startups. The firm was among the first institutional investors in companies including Automatic, Duo Security, Fitbit, HashiCorp, Peloton, Sweetgreen, Madison Reed, Pipedream, Icera, Ernesta, and Ring, just to mention a few. Jon, welcome to the show.
So good to see you, Nick. Thank you. I was saying earlier, we're big fans of the show. I love what you do for the industry, and it's great. And we appreciate you. Thank you.
It is such a thrill to have you on. So Jon, where did your entrepreneurial journey begin?
Yeah. It's kind of a different path into venture capital. My parents were entrepreneurs, so I was surrounded by entrepreneurship, really as long as I could remember. And, I was headed off to college, and I was, enamored by this new sport of riding bikes on trails. And, this was a while ago. So this was, 1986, 1987 kind of time frame. 86 when I first started riding these bikes on trails, or really 85. So before the sport of mountain biking was a sport, and I was headed off to college, and I had found a way to ask a bike shop to buy me a mountain bike to take with me to New Hampshire, because I was pretty into this thing and it was really fun, and I loved it. And the owner of that shop promptly threw me out. Kicked me out of the store, said mountain biking is not a thing, never going to be a thing. I'll sell you a road bike if you want, but otherwise get the heck, but didn't use heck, out of my store. So I was 17, and I was like, this is interesting. I've been, riding these things, and it's really fun. I think he is not seeing what I see for the future. So I had that insight really young about a market that I thought was going to happen. And I said, well, I'll just start my own. And so I did. So with, a lot of guidance and a lot of mentorship and a lot of help, I went into business and started a mountain bike store in Moose, Wyoming. And did that during my college years, and then many years thereafter. Brought my brother into the business, grew it. It was fantastic. And learned pretty much every lesson that I would later go to business school. But I had pretty much learned every lesson owning that business. Everything customer support, product, customer service, pricing, obviously everything financially related. And I just loved it. I loved being an entrepreneur. I loved the creativity. I loved seeing the market come into play. It turns out I was right. Well, many people were, but let's just say that the person who doubted the future of the mountain biking market was incorrect. We did see a market before it happened. It happened in a very big way, and there were all sorts of reasons why. There was a thesis on, before I even could use that word, as applied to a future market state. Anyhow, so that was a very early entrepreneurial bug. I'd continue. I would go on and to start two other companies as co-founders, and got introduced to the industry of venture capital from a college friend who recognized my entrepreneurial spirit and was trying to coach me on what I might want to do post-college, and exposed me to this wildly cool industry, which, by the way, then was tiny. And I started my career at one of the two firms that would hire undergrads out of college. That was Summit Partners in Boston. Summit at the time was incredibly small. They were on Fund 2. There were probably 20 people at the firm. Fund 2 was, I think, 230 million or something like that. And I learned the business from the founders of that firm, and met my co-founder, Phil Black, who was also an associate at that time, my true co-founder, at Summit. And we learned the business from the best. And I was investing in software and meeting entrepreneurs all over the US. And I got really excited by this new technology in the kind of mid 90s. And my bosses at the time, the people who were directing my work, said, don't waste your time in that. It's never going to be anything. The internet's not real. Like, this is crazy. No one, it's not for business. This is a science project.
Really?
Oh yeah. The whole industry did that. And I, of course, spent time in it anyway. This is pretty early days. So I went to grad school after a bunch of time at Summit, and promptly dove into the internet, co-founded a company in grad school with a classmate. internet e-commerce business that was phenomenally awesome from an experience standpoint, and helped start At Ventures, which was then CMGI's venture capital arm, internet-only venture capital firm. So I very quickly kind of, what I've done throughout my career has been, really, really early in future possibilities, future markets, or not even markets, future things that might become big, either trends or industries. And I've surrounded myself with just incredibly curious, talented people from all different sort of disciplines and skills and everything. And I've also, from a career and no surprise at True, I've always tried to take the most risk possible. We're talking about a business context, right? Of like market, product, timing. Typically at True, we don't take capital risk. That's very important to us to be in capital efficient markets. So that's a risk we don't like to take. And we don't like to take people risk. So a couple of themes that'll come out through our discussion around starting the firm at True. But in the case of my career, those were lessons learned along the way. Being super early into something is seemingly inconsequential as mountain biking, but then later being super early in the internet. Obviously at True, we've been incredibly early investors, initially in Web 2. You mentioned WordPress. And there were many, many others. Yep. Obviously, we were one of the first investors in device and hardware. With Fitbit in 2008, we were called crazy. We were called stupid. We were told no, venture capitalists aren't going to make any money in hardware. In particular, small early stage venture capitalists can never make money in hardware. And that would go on. We were very early investors in the early days of the cloud, in capital efficient cloud. We did extraordinarily well in that segment. And just sort of one of the things that I love about True and my partners and my team is that we have stayed so insanely curious about things that are interesting to our founders. And we stayed so incredibly enamored with all that our founders are doing. And we have a culture of curiosity and learning that we're consistently early in these really, really important and big markets. And, that's just incredibly gratifying to be in at the ground level of, kind of whatever. And we started investing in AI, and I think our first investment was 2015, but really in 2016 and beyond. We were very early in crypto. We did very well there, despite that market not being as big as a lot of us thought it was going to be. And so the theme of curiosity and possibility, and frankly believing. I hope we talk a lot about what is really important for an early stage venture capital to get right. And I would say believing in people is probably the number one. But anyway, so that's a little bit of how I got into it and how we think about it today.
So, I mean, you've mentioned spotting the next big market, whether it be mountain biking or AI, right? Different sides of the spectrum. Like, have you ever tried to reverse engineer? Like, what is it about maybe your own thought patterns or the founders that you've backed that allows them to see the future in a way that manifests, as opposed to, one of these trends that many VCs want to write about, but ultimately flames out?
So I think there's, first of all, let me say that, like, for all that we've gotten right, we've gotten many, many more wrong. And one of the most important things to think about for anyone practicing venture capital or listening that wants to is, like, okay, we all say this is a business about this is what we say. We say this is parallel business. It's about being right. You just need to be right, 5% of the time, by the way, and that's the number. It's 5%. It's not 10. It's not 20. It's 5 if you're lucky. And that 5%, blah, blah. And so we just need to be right. But so that focuses on being on the righteousness 95% of the time. And it's not, you do make money on more than the 5. So it's the 5 that really knocks it out of the park. But, so let's call it, another 10% of this. So 80+% of the time we're wrong. Like, wow, like it doesn't work. And that's, so when I talk to students or whatever, people that want to get into this business, and I'm like, I always say, like, you have to have a really, really good relationship with righteousness. And when I say good, I mean, like, you can't have righteousness. You can't, like, what's far more important is, and it's not even like being like humble or arrogant. It's not about that. It's about this deep curiosity to learn something purely for the sake of learning, not because then I want to go make money and make investment. No, like you have to see every conversation as just a path of really deep inquiry and learning about the people in this segment and what they think is interesting. And so, what I have found throughout my life is that, like, when I think about, we'll talk a little bit later, I think about lessons, but when I think about like how to stay in the zones of genius versus like all the other stuff, like my number one challenge is always to spend more and more time in that path of inquiry with really, really amazing people. And we would say our really amazing people are our founders. So to your point, when I kind of like go back and say, how did this occur? It always occurred from that deep curiosity and that sort of like stepping stone mentality, which is like, I'm not after like a thing, I'm on the journey. And we talk with our entrepreneurs all the time, and regardless of stage or size of like, we're just along a journey. Like, and it's, by the way, this is going to be a wild one. It's going to be like, we're going to have super high highs. We're going to have a lot of lows. Every single company has 3 or 4 kill the company moments. Like, we just got to know that going in. And when you frame what we do as that sort of this experiment to learn, or this opportunity to learn, and this opportunity to build things, and by the way, hopefully to build things that matter. We should probably have a whole conversation around purpose in our industry, which I think is always fascinating. But like, then all of these things continue to unfold and link to one another. And what you find, we are in a creative space. I would say our industry is, one of the most creative in the capital markets uniformly. So we're with these brilliant creators. And what you find is when you approach these decision-making systems, or when you approach these analyses, or when you try and say, like, how did we get to all of these sort of stepping stones that unlock the next sort of avenue or potential happen because we're in that creative space. We're in the mindset of creativity that is thinking about what's possible, believing in someone's talent and capability that they can make something happen, or that they can actually ask just a question that illuminates the path, and then acting on it. Like, you got to act on that stuff. So in early stage, and I'm talking, of course, about seed and early stage, but like, there's all this like, conviction, like everyone throws that word around, like it's, I don't know, it's a very important word in our business, but like, to truly understand what that means, I think you have to have very much a learner's mind, and sort of think about possibilities as realities, things that can be achieved.
Do you think some are just wired that way? Is that why some VCs continue to evolve and the categories change, but successful VCs persist, and then just some fade away?
Absolutely. I think some of the greats in our industry just, who I've had the great luck to be in boards with, be in rooms with, whatever. I always find there's this really there's of course tenacity, and everyone talks about all that stuff. Those are the obvious things, but it's much more the ability to retain curiosity and the sense of the possible, regardless almost of any situation, and retain the belief in a team, or in a market, or in a future. And by the way, be super judicious. Like, it doesn't always work. So, and it's okay. Like the whole, like, if you
this is the industry where that's okay.
It has to be. I mean, otherwise you would never take any risk. And otherwise, like, and by the way, like, I've listened to tons of your episodes, and I love I think it was Jeff Busking or Paul who was saying, like, be really careful of the time that a junior person in the career spends, because, like, it's a truism that the companies that don't perform as well will take all of your time. And the companies that are in that 5% require very little of your time. Now, of course, our job is, if we can just make that 5% like a teeny bit more successful, it's like 3x more of the fund kind of thing. So it's this really interesting thing is, like, if you can just help that, those top companies a teeny bit, but what happens is you spend most of your time on the companies in the, bottom couple of quartiles that are having issues. And, that's okay. It's part of the job and all that sort of thing. But, like, that is a great, it's just a great lesson that how you use your time and the mind space that you're occupying in. I work with my partners all the time on this. And again, invariably we have problem companies. I do everything possible to take problems away from my partners, my best athletes, because I want them out on the field working with those top companies that have this chance. And by the way, it doesn't mean we walk away. We're in it for the long haul and all that. But like through clear and open communication, it becomes really evident, when a market is working, when it isn't, when a product is working, when it isn't. And I think it's the investor, and frankly, I would say it's the team. The team has an even more higher opportunity cost. Their time is even more valuable. And one of the things we always work on with our founders when things aren't working is like, what else could we be doing? Like, let's let go of all the preconceived notions of like, we thought we were going to do this. If we run into a market that's really not happening, what else do you think? Stay in the inquiry. Like, what else is possible? And a lot of our great, there have been some unbelievable, pivot, but that's too hard a word. There've been some unbelievable creative moves that have happened in our portfolio over time because the founders have very quickly recognized, this one's not going to work, or someone just came into this market that's going to close it off. So what else could there be? So again, staying open, staying creative. Like early stage is the part in the capital markets where like it's messy. It's supposed to be. We can take these outlandishly crazy risks, recognizing that, when we're successful, it can transform society and life and work. And most of the time we're not successful. And that's what, like, it's the safe space in the capital markets for that. Like, that's what we're supposed to do.
Jon, if we knew which ones were going to be billion-dollar companies, we'd build portfolios of only unicorns, right? Or decacorns. But you've seen so many reps now. You talk about, companies that are struggling and you begin to, cards start to reveal themselves over time.
Yeah.
And if you think back, are there milestones at certain time periods where you start to get insight as to whether the companies can break out? Because some of these are very wayward. Some of them stay in this discovery mode for a while and then all of a sudden, boom.
Yeah.
So like, how do you think about like the evolution of development and your insight as to which ones have what it takes to take it all the way to IPO?
Yeah. Well, I would say there is no one rule, because not even close to a pattern, because I've had so many other patterns happen. I was being pitched this morning by an entrepreneur that I used to know in the drone category, and we were very early investors in 3D Robotics, which was started by the brilliant Chris Anderson. It was just an awesome company, and it took off. And I'll directionally get some of these numbers wrong, but it was kind of like 5 to 7 million, 30 million, 100 million.
Whoa.
Annually, right? And, they had everything, the technology, and they had the team, and Chris is brilliant, and all the money they needed, and blah, blah. And, that market obviously got a lot of things happened to that market that took it away. Regulation, competition from China, DJI in particular, kind of the whole industry. I think there was one Christmas where we had sold in something like on the order of $100 million. It was like 80 million of the 100-year that was sold into the channel in Q4 or something like that, some big number. And that was also the year that many competitors basically dumped on the market. So the prices were all, so my point is like, in that investment obviously didn't kind of continue to progress where we thought it was. But I mentioned that because like we were just talking about the way that industry developed this morning, and all of the ingredients can be right. And then of course, like, things out of an entrepreneur's control can come in and make a market not happen. The opposite's also true, which is that, you can be building a nice company. We're insanely fortunate investors with Garrett Lord at Handshake, and we've been, super pleased. Handshake's built a beautiful business in college recruiting and job board, and they have something like 95% or somewhere on that order market share in colleges, and it's been a great business. I think we've been investors there for 8 or 9 years. And this calendar year, Garrett decided to use that network because decided to deploy that network because they have such an incredible mapping of where PhDs in physics and all of the sciences are, and to basically turn on a reinforcement learning engine for the models using humans in the loop and using his humans in the loop. And that Handshake AI, it's a well-known story now of his refounding of the company. But he spotted the opportunity. He had incredible resource to go after it. And that's like, you can look to Garrett's X feed and other, because he's often quoting the new ARR numbers, which are just growing like crazy. But so I'll go back. So when I say there's no rule, there kind of is only one rule, which is that our job is to back people like Garrett and like Chris Anderson and like James Park at Fitbit or Jamie Siminoff at Ring, who, by the way, Ring, brilliant success, had so many tough moments, right? All hard work at Fitbit as well. I mean, all hard work.
Fitbit had some tough ones. Yeah.
Yeah. Or Amy Arrett at Madison Reed, or Julie Bornstein twice. Now the second time with Daydream. We should talk a little bit about repeat founders and stuff, but, so our job is to empower these creators early and throughout the way, to believe and stay in the game and support them, because yes, you can have a situation where a market disappears in the drone space, but you can also have a situation in which a market completely opens up to you. And when that occurs, which it has for many of those companies, Madison Reed is just a phenomenal example. Pay Near Me with Danny Shader, another phenomenal example. And by the way, these are companies that are more than 10 years old. So we should also talk about duration in early stage venture, and why duration is a feature. It is not a bug. Duration is a feature to our industry. And I think a lot of people have that somewhat confused in this very noisy, bubbly moment. And we should maybe talk about why and how. But so anyway, our job is to find these creators and we've built a firm to support them for their entire journey. And what that means is we have capital for the whole journey. We have, large core funds, then we have select funds, and select funds can keep investing in companies. And of course, as you said, we've had, great success over 12 funds. We have, we've invested with pretty much everyone up and down the stack. So we've got great relationships with other VCs. I think our portfolio raised well over $1 billion this year, which is, great. There's all sorts of capital coming in to support our businesses. Anyway, so our job is to find and identify these brilliant founders and then do everything possible to support and empower their success, embolden their success. And we see our job as supporting that founder and getting everything out of the way that can get in the way of their creativity. And what can get in the way of their creativity? Well, like limiting degrees of freedom. If any of these companies had, cultures or boards or whatever that would say like, no, this is your lane. We work really hard to not have it be anyone's lane, because what we're trying to do is find, as my co-founder Phil would say, lightning in a bottle. And sometimes that lightning, happens kind of late in the game. Sometimes it happens right away. And when that happens, great. Like, bar the door. It's great to be that slugger when you hit home early. But most of the time, you're really working hard to build something successful over a long period of time. And we need to be there as a system and as a firm for the entire time and be a source of support and strength.
So tell us more about that, right? I'm going to bite. Why is duration a feature, not a bug? And why is that especially important right now?
Okay, so good things take time. All of the companies that every venture capitalist wishes they were investors in right now, the OpenAIs, all the big, like those were founded a long time ago. Those were messy, wandering paths to the successes that they are now. If for venture capitalists in early stage, I'm not talking about late momentum. By the way, that's where most of the dollars are invested today, in consensus momentum. That's where the dollars are going. And I have issue with that too. We could talk about that too. But I think one of your prep questions was like, what conventional wisdom do you disagree with? And I think I said most or something like that, right? Because I think we need to think for ourselves. And when you're an early stage investor, we are designed and we succeed in a 10-year period. Okay. So if I look at, and by the way, we've been in AI, as I mentioned, since, I don't know, to 2015, somewhere in that ballpark, and very aggressively in the years that followed. If I look at where AI is going to be in 5 to 10 years, I'm not really interested in investing in, not to pick on a sector because I love it, and we have like the next vibe coding company, right? Which there's tons of, and it's like, or the things that are easy to see that are getting quickly funded all around us. Like those decisions that are being made to like catch the current shiny object that one of your guests, another great piece of advice, don't chase the shiny, but like there's a lot. And so the stuff you can see is not the stuff that's going to be big in 5 to 10 years. And we venture capitalists get paid by our limited partners to return great funds. And funds are structured over 10 years. And the only way I know to return a great early stage fund is to build a portfolio of 30 to 40 companies that all have fund maker potential, that all have the ability in 10 years to be worth your position therein, to be worth more than the fund. And by the way, the only way to do that is to make sure that you're a large shareholder in that company. And the only way to do that is to do it early, not to jump into a party round on an unpriced safe, and like hope that you get a markup. By the way, like markups can be the worst thing that can happen. Like unrealized values can be the worst thing that can.
Why is that?
Because if you prematurely mark a company up, a couple things happen. The first of which is like the common stock gets really expensive. So like we're supposed to be building these companies so that our employees can have, incredible fortune and great upside. The other thing that happens is the degrees of, or I should say the aspects of opportunity become really narrow. So, there's a ton of, we learned this. Here's another interesting thing. We learned this in ZERP and as an industry, and we're doing it again. So we're celebrating every single day on X, the latest AI company that raises money at $15 billion post. And by the way, it's private, of course. And maybe it has a lot of revenue. A couple of them have a lot of revenue there. By the way, there are a couple of companies that are breaking out that absolutely deserve, no question. But there are a lot of companies that are raising at very high valuations. And I think it's a disservice to a couple different things. The first of which is the reality of the path. It's never a straight line, ever. So you need to have degrees of freedom in that plan. And possibly, if you raise enough capital, of course, the dollars themselves can create degrees of freedom, but the valuation sure doesn't. That locks you into, you've got to meet or exceed that, or else all bets are off. And you're not really doing a lot of justice to your common stock employees, right? Because they get so. And I wrote about this, the tragedy of the whatever. I've had a blog post about this issue. I mean, the Valley was. The Valley became the Valley because employees did really well on early equity, and that's what attracted a lot of talent into young companies. But if your young companies are valued at billions of dollars, then you've got many more rounds and many more years to go. Kind of tough to see that. The other thing about duration, you said it earlier. I have lived it. I mean, I have lived in this cycle and was in the 99 cycle, and we have had, our funds are distinguished by absolutely blockbuster companies. Pretty much every single fund, a few of them, some have more than others, where that company took, 8 years to mature, 10 years to mature. And, you sure as heck, the math just speaks for itself, but like there are certain investors that want to buy IRR. Early stage is all about multiple. And so, the value of a company in those out years when it succeeds, it goes up and fast. And so your ability to, again, be in early and stay and be a part of the value creation process, it's critically important. And the other thing I would say is that I think needs to happen is, we believe in DPI. Our funds are characterized by very high DPI, so money back to LPs, and that has been critically important to us since the beginning. Unrealized valuation, it doesn't really help anybody. Like you can't eat it. Doesn't help your employees when it's too high, and all of the talk in the industry right now is on TVPI, which it's great. Like we have a ton of tailwinds are amazing. We've had all these up rounds, right, et cetera, but our job as investors is to actually realize liquidity within a particular window. So
how do you square that circle with DPI and duration, right? Duration is a feature, but it's so long cycle on these early stage investments. So, how have you been able to drive meaningful DPI when, you're taking such long positions?
So, I'd love to say that, 10 years is enough, but the reality on most venture capital firms are structured for 10 years, but they of course have extensions. 10 isn't, but 15 is, so typically what happens in our funds is we have a bunch of early successes that get acquired along the way. By the way, we had 4 exits in Q4. 3 of them driven by repeat founders. 3 of them of the 4 driven by AI tailwinds. These are in companies that were started in one case, 2015, kind of 2 cases there, and then a couple cases, 2018. So cool. 10-year, 8-year, kind of like long journeys and really nice exits. And a lot, we when these close, we plan to send a lot of that DPI back to our investors. But it's like, when you build a portfolio, how do you square the circle? You build a lot of value across a lot of companies, and you recognize that exit is your job. And by the way, you align with founders who, again, 3 of those 4 founders are repeat founders. We've had success with them in the past. And all of those companies had options to take capital they raised capital all along the way, but they never raised it at the highest price because they're experienced entrepreneurs, and that closes windows, not opens windows. So it's really about alignment with, between investor and founder. And look, we want the biggest numbers possible, and we want to change the world too. Of course, like everyone wants that. But there's also just a way to build a company that I think gives you maximum degrees of freedom and maximum creative opportunity. And there's another way to build a company where it limits that. And I think too much capital too soon, too much valuation too soon. It also, investor selection can be a problem. If you're optimizing on valuation, you may be missing other things. If you're optimizing around quantum, you may be missing other things. By the way, this is so ironic because like the number one thing that has fueled all of the waves that you and I have participated in is capital efficiency. And every subsequent wave of, Web 2, cloud, mobile, the tools have become more powerful and the costs have gone down. This wave is that like times a million, right? It is so powerful to build on these tools.
Is that what's most different about this cycle versus previous?
Well, I would say I'm always careful on that. This time's different. I would say it's the same, but it's even more. So in other words, I would say it's the same pattern, which is that when we started Web 2, we started True as the beginning of Web 2. And, we funded Seth Sternberg at Meebo right at Coupa Cafe, which is like a block away from where I'm sitting.
Oh, yeah.
And I met Seth. I had known him from a prior company, from a prior firm. And I said, oh, yeah, this new thing you're building, Meebo, sounds great. He goes, yeah, it's 3 of us. He's like, I don't need to raise any money, but I really would like $50,000 to get these servers off of my credit card. And I was like, $50,000? And they were serving, I don't know what the numbers were. They had maybe 100,000 users, but like a lot of users. And I was like, done. Like, we can do that. Like, that's awesome. Let's go, And so, in those early years, we started True because, by the way, DHTML, which later became, at first it was like HTML5, Ajax, all these different technologies basically that as broke up the way that apps could be delivered in browser and decreased the cost of development dramatically and allowed people to build, quote, mashups, right? These new things that were a little bit of this, a little bit of that. And then, of course, AWS. And before that, Yahoo opened up their APIs. And so, kind of the game started there. But the result was that entrepreneurs could build these really interesting products and try them, back to this creativity and experimentation mindset, and learn a lot quick on small dollars. And that was truly why we started True. When we started True in 2005, there were very few seed investors. There was Ron Conway, who's like amazing and was wonderful to us when we started, and a couple others. And then there was Sand Hill Road, and the smallest round from Sand Hill Road, you could raise $5 to $8 million for 40% of your company.
No kidding.
Plus a 25% option pool, maybe 20 if you got lucky. So you're selling 60% of your company day one for $5 to $8 million. And by the way, the bar to get, and so like we weren't the only ones, of course. Josh started first round, and Brad and the Foundry guys did their thing, and we were all and still are very close friends, because in those early days we also collaborated a ton. We were kind of the new kids on the block, and Mike Maples, of course, and we get together a lot and say, this is how it's working, let's share deals. But capital efficiency is what broke open the venture industry, and it continued in the cloud, and you've seen all these great new funds since that time. And now you don't need, I mean, again, we're like the one person, one employee unicorn and all the stuff that we're all talking about. Like, I mean, you can build something like tomorrow. Anytime an entrepreneur comes in, actually, this happened the other day. And I was like, so tell me about the prototype. And they're like, oh, well, we haven't hired a tech team. And it was just like, what? You don't need to hire. Like, you and I could do one in the next half hour. We could build a prototype, and would it be perfect? No, but could we post it? Yeah. And we could learn a lot. And so the power of these tools and the speed and related, the cost, I think is one of the most exciting aspects of this current wave. And, you know, the irony, we're so early. I mean, we're not even like, yeah, I know you use the baseball analogy a lot. Like, we're not even, maybe for quantum, we're not even like making baseballs and baseball mitts and bats yet. Like, but like for AI, we're kind of like on the way to the game, maybe, or on the way to the first practice. And we fully, and by the way, the concentration of private capital into so few companies is, I think, just an indicator that, you know, the market's really narrow still. We're not at the broadening where truly the application layer gets built on top of all this CapEx. And that every other wave, if you study every other innovation wave, Web 1, you know, Web 2, cloud, mobile, the value of the application layer as a multiple of CapEx is somewhere on the order of 5 to 10x.
Okay.
So if we're putting $5 trillion into the ground, that's what Jensen just said, right? Or I think it's McKinsey also estimates 5 trillion into the ground. 5 times that number is an awful lot of value. 3 times that number is an awful lot of value. So we get it wrong. So there's too much cap. 2 times that number is an awful lot.
You could be off by an order of magnitude and it's still huge.
It's huge. And that's the application layer. And
is that the non-consensus way to be investing in AI right now? Because True is known for contrarian style, non-consensus investing. Like, how do you access AI in a way that's not overpriced and bubbly and bloated?
Well, so 2 answers. The first of which is just data. So there's something on the order of 1,500 seed deals a quarter-ish. Some quarters it's like of mainstream seed that would be U.S. kind of considered venture capital available, or like available to us as venture capitalists. Okay, so it's like 1,000 to 2,000 a quarter. You and I could sit here and talk all day long about, oh, did you hear the mega round into this and that's, but like between us, we could spend this whole podcast without using any of the tools. We'd probably get to 30 names this year, maybe. Like, I don't know more than 30. I don't know. Maybe you probably know a different 30. Let's 50. It's a tiny fraction of what's actually getting funded and what's actually getting built. And so, and all the data that we see, seed rounds are still roughly the same. It's, you know, $1 to $5 million. It's sub 30, 40, whatever. 40's high, but whatever. So like in the 20s, plus minus. And some founders are, you know, it's like, it's not dramatically different than where it was, but the conversation and the FOMO behavior is distorted by what's in the headlines. And the other great piece of advice someone gave you on your show several weeks ago, I don't remember who it was, but I used to always say this as well to our founders, is please don't read the industry like news on funding. Read the industry news of like, if you're in a category, you got to know everything about the category. You got to know every person, like deep curiosity, but like it's all noise. Right? You have no idea like who raised what at this and why, and it doesn't matter. It's not like your adventure. It's not your mission. So I guess the first answer to that is like the math. It's like most seed deals in AI, even in this white hot space, are still being done roughly in the parameters of what makes sense for most seed investors. Our core business is to write a $1 to $5 million check, kind of super early day one, and be a meaningful partner to the founders.
You've brought up repeat founders multiple times. Yeah. Like, is there some insight on that you'd like to share? Yeah.
So the majority of, so when we started the firm, we said like our objective is to be the entrepreneur is the customer, first of all. Like every business has venture is such a funny business, and please ask your friends who are in it and partners are like, hey, who's your customer? And I remember before we started True, I was in the venture capital business, and I would go around and ask people, and some of the smartest, like most famous people, would be like, my partners are my customers. I serve and I'm like, yeah, you know, I get. Or my limited partners, I was like, it doesn't feel right. And to me, it was always the entrepreneur is the customer. Like, you provide a product and a service to an incredibly valuable customer for society and the world. And you got to make that product absolutely amazing so they keep coming back and they tell all their friends. And I'm a great student of brand, and I love brands that, of course we could talk about how amazing Blue Bottle Coffee is, or Sweet Green, or Peloton, all these things have been. But I also think there's like amazing brands in the world, Toyota, people love their, like there's just, and there's a magic in a customer loyalty relationship because that brand has earned it, and that brand has been tried and true for that customer. And we want True to be that brand. And what it did early on is, in addition to we founded the firm on values, in addition to like really, really wanting to have just an exceptional, enduring firm to support human creativity forever, we really wanted to think about every customer touch point and get rid of all the other, for lack of a better word, crap that typically happens in a venture capital founder relationship. And so, like incentives, but we don't have attribution. I've talked about this forever, but nobody really gets it until they experience it, which is that all of my partners, all 10 of my partners, 5 of my venture partners, by the way, plus my other partners who run big chunks of the operation, plus any associate, any principal, anyone on my team, can call any of my founders anytime they want, help them in any possible way, and be of service to anyone in the portfolio. And so we don't get paid by the deal we do. We don't we don't do any of that weird attribution thing. We don't vote and need consensus. Usually if there's a vote that's too easy as a managing partner, I'll kill the deal because the easy ones are too adjacent to us. They're too, we're again, this 5 to 10 years out. The hard ones are really hard to see. Like, wait, you're actually going to try it and build a brand new satellite company in 2015? Like, this is such a great example, by the way. This company is called ICEYE, and it was just General Catalyst just funded it. It's been getting all sorts of great press. It's an absolute monster company. We funded two master students on their thesis in Helsinki. We had relationships through one of our venture partners with that community, and so they were outstanding. They were kind of our kind of founders, and we seed funded the company. At the time, there was a line I used on that I recently saw on a different publication, but we were deciding between teen bullying apps and satellites. And I don't know if you remember this era. There were all these bullying apps, right? And they were so hot. All well-known VCs were funding them. We were just like, what is going on in our industry? Here's a satellite company that's going to go change the world. And so, that was just one of our markers back then of purpose and the long haul. And, here we are 10 years later, and that company is an absolute monster, an absolute fun maker many, many times over, many times over.
I was there 2 weeks ago, and they were talking about this company constantly in Helsinki.
Yeah, it is such a great story, and the founders are amazing, and they've built, anyway, it's wild. And so. And
was this a repeat founder scenario or not?
Okay. Yeah, that's right. It's in the context of the repeat. Sorry, we got off on these amazing founders. So this was in the build a great experience for the customer. And so back to that, we can have fun with editing, because back to building the great, partner and the great brand for today's most creative entrepreneurs. So a lot of things had to fall out of that. And one thing that had to fall into that. So I talked about building our incentive structures so that our partners weren't getting in the way of providing great customer service. Mm-hmm. We also invested very heavily in what we call platform, but it's our belief, and I've been an entrepreneur, being a visionary founder is really hard. It's really lonely. You can only talk to your significant other or spouse or brother or mom so much about it. They kind of get tired. And by the way, for most of us, this creative thing we do is, I don't know what's the right, it feels like obsessive. In other words, when there's a creative problem, it's that is it. It grips you. It's all you. Mm-hmm. And so, and if we're doing our job right, investing in things that might be there in 5 to 10 years, there's no right answer. There's no, you can't be oh, how do you do this? Oh, I did it this way. Oh, great. I'll do it that way. Right. I mean, certain things that don't matter, like how you run a stat, great. That's easy. And now all that's in the models, but the real hard problems, there's no one to talk to. So very early on, we recognized that truly cutting edge founders who are doing net new behaviors, net new things for the first time needed a peer group. That peer group for us is our founders, our existing founders. So we decided to invest very heavily in any way, technology, systems, knowledge systems, events, but not like, cocktail parties and schmoozing, but like real events. We built our own YPO forum model for many years. Many of those forums are still operating for CEOs and founders. And so we get our existing founders together, usually without us in the room, but we're safe to have in the room too. We're not looking over anyone's shoulder. We just want them to have a safe space where they can ask the tough questions. And that has, because of our values over time of collaboration and curiosity and believing in people, that has become so insanely valuable, like absolutely incredibly valuable. How
do you get the new founders to invest in that,
Yeah, it's really interesting. So,
because everyone's being asked to join a Slack group or a virtual group, and it's like, yeah, but that's different than the real kernel of connection and
so what's interesting is by the time someone takes our capital, so you'd ask about repeat founders. So about 70% of the deals historically that we commit to have been introduced to us by our founders. We hear about deals from everybody, but the ones that rise, so like it is a very high fidelity channel. And the reason why it's a high fidelity channel is that we do spend so much time with our founders and they get to know us so well. And every new deal, typically, even something that doesn't come in, we're like, oh yeah, we have, a bunch of brilliant minds in quantum over here. Why don't we get them involved in the conversation? Not because we want to but we're just really curious. What do you all think about this, new technology or in the context of AI? There's obviously, we have 85 AI investments and those founders and teams are super close and are meeting. They've created their own sub community completely without us. And they're meeting, I don't know, every 2 or 3 weeks, and just hammering through the like most meaty topics of the day for each of them. And so, I think you have to believe, seriously, Nick, you just have to believe that if you set up that humans are good and good creative humans want to share, and if you set up a safe space for them to share, which means the VC's not looking over their shoulder like, oh, I'm going to get you in the next board meeting because you said, we don't have time for that. We don't care about that. When you're on a mission to build the next generation satellite company or this insane company called Inveda, which is also a monster, which we funded in 2020. Vishwa Kolaru, he was founder of Inveda. He was introduced to us again by another entrepreneur, one of our existing entrepreneurs. And they, had this wild dream to use AI in 2020, for, basically faster and better drug discovery to create medicines from biology, from the 97% of biology that is unsequenced and not understood. And Inveda has completely exceeded all of our expectations. And by the way, we're super early in the journey, 5 years in, and it is an absolute monster and a rocket. And so we've got a lot of really insanely sort of deep people in these categories. And so whenever we're doing something in the category, we call Vishwa, right? We're like, hey, what's going on here? We call the founders of Basecamp Research and they're like, oh, I'd love to meet that company. That'd be fun to get involved. Oh, by the way, here's 2 other ideas. So we're in this constant dialogue. Why? Because we believe in our founders and we are deeply curious about the future of the world. Not because we have a transactional relationship with them, not because we're on their board, but because we're all in this journey together. And when they connect, that's the setup. The setup isn't like, how do I get more valuation or what do I need to worry about? We don't care about any of that stuff. That stuff doesn't make any money in venture cap. By the way, terms and marginal valuation has made me $0 over the course of my entire career. But being with the right founders, being with the founders who can, the Vishwas of the world or a Pekka or a Fall, that's what you live for.
True partnerships. Pun intended. I said
it. Totally. And so when we get into these relationships and Todd Sacerdoti, his company Pipe Dream was just acquired by Workday in Q4. We funded him with Brightroll in Fund 1. I mean, Todd is one of these just tenacious, brilliant leader. Absolutely what you see is what you get. We have this ease of communication on the important things, always. And he's always curious about where the world could go. And he's super open, like all the things I love in great founders. When Todd wanted to start his next company, Pipe Dream, it's like, of course. Absolutely, we want to be in business with you. So we've done that, I don't know, close to 70 times. I think it's more like 68 or 67, but it sort of depends. We've funded a bunch of entrepreneurs more than twice, 3 times. I think Kevin Rose, we've been in 4 or 5 of his things if you include them all. And the why is because these are the most brilliant creators of our time, and we want to be invested and partner with them in everything they do. Like that is a phenomenal investment thesis, right?
Yep.
And they're going to keep creating, and they're going to be surrounded by other creators, and they're going to introduce us to great creators. And so we've built a business based on this, and we call it our flywheel. And it's like, it's always, it literally is. We always say one of the founding principles was like, work with people, and always know new people. So the curiosity motion that we have in all these markets, we're just always attaching more people to the flywheel and be like, oh yeah, let's jump into that thing together. And have you met this company yet? Have you talked to the folks at Basecamp, that are, by the way, building another monster company that we're super fortunate to be involved in. And so repeat founders are a key part of that, but so too is founder referral. And so too is, engaging our founders in all aspects of our business, and never being too precious about, we're super curious about, there's another advice to people in the industry is be really, really careful with certainty. I talked about righteousness earlier. Be really careful with certainty, because like that is not a thing in early stage. And so beginner's mindset, what could we create? What could we learn? I'm wrong all the time. It's what I love about this job all the time. Right.
Even when you see a pattern that holds like across 30 companies, all of a sudden one breaks it, and it's like, okay.
Yeah. And I love that. I mean, I love that about it. It's like, it's the world's most incredible job in that regard. If you're designed to be okay with failure, and if you're designed to be okay with being wrong a lot, and frankly, if you truly love and believe in people and the power of teams, that's,
I mean, we live in the business of overcoming the odds and just breaking consensus, right? Like the future is going to be different. And so you just see people, pull off incredible things, in a business context. It's just unbelievable when you see people do this.
And the moment, right? And people ask me this all the time too. It's like, how do you know when something's true? You asked me a minute ago on contrarian signals. It really is a little bit of like, there's just something different. And I get really, the right word is suspicious of both my own thinking and others, when there's a lot of other things biasing decision making, like headlines, or this is going to be big, or my competitor just won, or I just lost it, and so you really have to have almost like the fidelity is the word, but like almost a careful cleanliness of thought and process, and by the way, decision making across a team to like diagnose where biases could possibly be seeping in, and making sure you're pulling that out of the decision. And you actually do know when something is so wildly weird and different and interesting. By the way, we both see a ton of weird all the time. That's not it. Like it's that funny alchemy of like, that might just like, it might work because not just one thing can become true. It might work because these 2 or 3 really vague signals that you're seeing out there may come together. And, we're spending a ton of time right now in different net new interfaces for data, broadly speaking. We're investors in Sandbar, which just came out with their Stream Ring, which mine's over here. And we're spending a lot of time just in and around new interfaces for sensors, data entry, all that, because ubiquity is here. Like soon, like I don't know if you watch Pluribus or not.
I do.
Yeah. Okay.
So we know what's happening there.
Yeah, I'm not just spoiling, but it's like there's an interesting thing when the consciousness is ubiquitously aware of everything, and that's going to happen. I've got like 8 devices here in my office. We've got you're going to get into I don't drive a car that has this, but like a Tesla or whatever, someone gets in a new car, that's going to have sensors. That's going to pick up everything. It's all going to be available to put into models. It's all going to be available for intelligence. It's all going to be available for decision making. It's all going to be available for agentic things to happen that we give it permission to do, like super soon, very soon. And so earlier we said, well, what is that, next application way of look like? Intellectually, we can say, okay, the next thing is the application layer. Great. But intellectually it doesn't get you to contrarian thinking. Like we know the general space, right? Mm-hmm. But then entrepreneurs can come in and they say, well, if these few things happen, then agents are going to be making these decisions on your behalf in possibly this way. And if that happens, then you might need this thing up here. And so really kind of grounding ourselves in that thinking, it's not like, I want to say like cleanly, because it's sort of like without all the bias of like, oh, I can't worry that so-and-so might do it, or, no one's going to act like that. I actually have to have just basically principled investing to kind of follow the possibilities of marketplace developing. And when you're with a team and a founding team and you can do that together, it's magic. It doesn't mean you're right, but it's absolutely magic, because you're like, okay, this is the journey we're going to go on. And we can do our part. We can provide you with capital. And of course, this amazing network, been doing this for a long time and blah, blah, and all that. But hey, let's agree we're going to stay wildly, wildly curious, because this is a journey and an adventure. And I've got all the capital in the world for exploration. But wow, your time is precious, because if you don't do this, I want to fund you to do the other thing. And so let's have a conversation that's like, I don't want you to march to the death or any of these weird, no, do it until it's not worth your insanely talented team's time. And at that point, we should change and do something else. Net new, great, new cap table, new this, no problem. We're designed to lose lots of times. That's not an issue. Mm-hmm. But keep the edge to go find the thing that is massively big, instead of settling for some small thing. Because the creative entrepreneur is way too valuable for our society to have.
It's not worth it, especially on a 10-year journey. Yeah.
Especially now. Yeah.
So Jon, earlier in that chat, you mentioned good risk versus bad risk, right? These different risk centers. You also mentioned long-term thinking versus short-term and frameworks around that. Can you just give us a couple insights around these topics, risk and duration of decision making and thinking?
So the risks we maximize at True are product risk. We invest, there's no product. Hopefully. Market risk, although it's funny, you can prototype now, so even that is getting kind of easier, but I would say the real products are not out. Market risk, if we're doing it right, I don't know what a market looks like in 5, let alone 10 years, but that's kind of what I'm aiming for, right? So the ultimate in market risk, and then timing risk. I can't tell you what OpenAI is going to build in 5 months, let alone 5 years, or Apple or Google or any of the hyperscalers. So, timing is a problem from a competitive dynamic standpoint. Timing is a problem because you need money to go along, all that. We accept all those risks. What we try not to do is take capital risk, as I mentioned before. It's really hard as an early stage venture capital firm to build battleships. It's really hard as an early stage venture capital firm to go build a new GPU and all this. So we stay in capital efficient things, and then people. And we talked a lot about that in terms of really using our networks to understand the lineage of people, where they've been, what they've done, their, curiosity, capability, teamwork, all that. And so we spend a lot of time on people, and it's because our belief is that people are everything in a creative endeavor and in the creative economy that we live in today. And so that's our framework. But what it does for us is it just allows us to objectively say, by the way, are we taking enough? We want to maximize risk, not just take risk, maximize. So if a market's pretty easy to see, we're kind of as a team, we're kind of is that maximum risk? Really?
Oh, wow.
Is there some other iteration of that market that we should aim for? And if so, how? So what it does is it grounds our conversations as a team into, are we really striving? Are we really trying to build fund makers in every single check that we write? And it cuts out a lot of deals that are okay for one or two reasons, but they may not be the Invedas of the world. They may not be the iSize of the world, the Basecamp Research, or historically the Pelotons, the Fitbits, the Duos, all that. But the one thing I would say for just investment in general is just know what risks you're taking.
Yeah.
And if you're pretending to yourself or your partnership that you're not taking risks, that is failure. Absolutely you will fail, because that means you're not understanding the risk. I always talk to my partners, and I'm like, I don't care what, like, I just want to know what they are. And then if we know what they are, let's max them out. Let's not try and make it, oh, it's a little better because they're going to build something that looks a little bit like this thing Google. I forget it. We don't want to compete with Google. Like, I don't want to be no. I want to be like way at the other end of the spectrum. So what could be possible? So it allows a framework to talk about what we're comfortable and what what we know and what we don't know, right? The known unknowns, which is what we need to kind of truly aim for.
Jon, if we could feature anyone here on the show, who do you think we should interview and what topic would you like to hear them speak about?
You do a great job of having, industry players, venture capital. Like your guest list is awesome. And other guests have said like, oh, Warren Buffett or Ray Dalio. And I'd love any of those people to think or talk about venture capital. But my honest answer is I would love to hear more about the creative process for artists, for musicians. Totally. If you could have Tom York from Radiohead on your show, I'm here all day long. Well, I'm here all day long anyway, but I think there's something in the creative process that we all can learn from other adjacent creative endeavors. It could be film production, it could be art, it can be music. I'm a huge music lover. And so there's something when I see that happen, when you see a John Mayer do what he does, or you see, there's a lot of preparation to stay in that creative mindset that these incredible performers or artists, I should say artists do. And so my honest answer is I think a little more of that in our thinking would be very powerful.
I love it. My favorite book is The Creative Act by Rick Rubin. So
absolutely.
He would be the man.
When it came out. Exactly. Like that to me is like, yeah, gospel, right? We really need to understand that. Yeah.
Jon, do you have any habits or behaviors that are a secret weapon?
I talked a bit about it earlier. This whole notion of zones of genius and understanding what I need to stay open and creative and curious, and this relationship with time and keeping a lot of space around. Because when something strikes, an idea, an exploration, time just disappears, and we live for that. That is like those are precious, and the kind of like running from one thing to the next is not that precious. Those are not the days you're going to remember. And the other is I truly love people. It is really, really fun for me to explore a topic with a team of people, and like there's just kind of nothing better. So. Yeah, staying in those zones is probably the secret weapon. I probably think way too much about it, but I look at each day and I look at each minute and I'm like, okay, how many, what do I need right this second to stay there?
And then finally here, Jon, what's the best way for listeners to connect with you and follow along with True?
Yeah, so LinkedIn, X less. So I do a lot of posting on LinkedIn. That'd be great. And social, I'm Jon at True Ventures, Jon. We want to be accessible and available, so reach out any way possible. We'd love to hear from you.
He's the legend, Jon Callaghan. The firm is True. Thank you so much for doing this. This is like a bucket list item for me, so I appreciate it.
Super fun. Well, we love what you do. Thank you.
Love it. Take care.
See ya.